Hi, I'm Pattu from freefincal. This is a question that I asked yesterday. Can you manage if the stock market falls by 50% and takes years to recover? Many people misunderstood what I was trying to say. I'm not trying to say that the market is going to start falling from tomorrow. I don't know what's going to happen. It may not. I have no idea. I'm not talking about the raising yields and how it will impact the stock market and so on. I'm not talking about the stock market. I'm talking about your personal portfolio, your personal money situation. Can you manage this kind of a fall? I'm not talking about emotions here because we cannot predict how we will react emotionally when something like this actually happens. I hope it doesn't happen, but it could happen, and I don't know how we will react emotionally. I'm not talking about that. When the going is good, when there is no such disaster happening, can we think about what would happen to our portfolios, what would happen to our monthly cash flows if such a situation happens, and can we think about it logically? The reason I'm saying that is, if we can write this down somewhere, hopefully by some stroke of luck we might remember that we did this exercise when something like this actually happens. Because yes, emotions are always going to be the big role to play in such a situation, but there must be some place, somewhere on record where we have a logical answer to this, and that's what I want to talk about. And there are different kinds of opinions about this, thoughts about this. Some people ask if this is really possible. Yes, it can definitely happen, and people have, especially young people, have rushed to say, I will invest more, it's a great opportunity. Yes, it's a great opportunity, but I'm not talking about investing more. Yes, that's fine. When such a thing happens, many people may not even have a job. Then only we have to talk about investing more and all that. So let's not get carried away about the people will say discount and all that. That's not what I'm talking about. The government. Some people think that government will prevent all this and they will do something. They may or they may not. I'm not talking about a drastic, dramatic drop in over the next few days. Not next few days, over a few days. Excuse me. Don't misinterpret that. Over a few days' time. I'm talking about a very gradual fall that happens over a few years, so that the recovery also is slow and takes over a few years, and the market is underwater for years and years and years, where you get a string of negative returns. And there are many people who are in kind of denial. They say this is volatility, not risk, and so on. I cannot talk to them about this. I think we'll have to part ways if that is your opinion. I'm not talking about a Japan-like situation. No, that's a very, very different situation. I'm not talking about that. I'm just talking about a huge fall and very long-term recovery that happens. So I have thought about what will happen to my portfolio. Again, I will not know how I will react when something like this happens, but this is the logical thought process I have about a 50% drop. So if you look at my retirement portfolio, it will decrease in value from 50 times current annual expense to about 32 times current annual expense. I have assumed that my equity holdings will drop by 50%, and my NPS holding will drop by 20%, because that has got about 15% equity and some gilts. So there will be some kind of effect on that as well. So my current asset allocation is about 60, 63, 64% equity or something like that. Rest of it is in debt, NPS most of it, and then PPF. So I might have a job, so my cash flow will not be may not be affected too much. So if I'm far away from retirement, then I might wait for a recovery, even if it takes a few years, and then just sit it out, of course, theoretically speaking. But if I'm retired, or if I'm very close to retirement and this kind of thing happens, of course I must not be having 60% equity when I'm close to retirement or I'm actually retired. But even if I have a small amount of equity, and if this happens, then I'll have to scramble and change my asset allocation and so on. So this is the reason why in my robo advisory template I have given a margin of 15 years. That is, for the first 15 years, the income is assumed to be guaranteed and indexed to inflation. Then the rest of it is managed in three buckets of low risk, medium risk, and high risk. That is the reason to try and handle this kind of a huge downturn and a very poor sequence of returns for years. Now, luck plays a very, very big role in this. Now, I have talked about starting investing in June 2008, and for the first 5 years, I did not have returns and so on. But I also did not face 50% loss in all this 12 years or so. So, if I had faced this, then I would have probably ran away from equity. I don't know. Maybe I would have never invested again, scared. That also could happen. So, luck plays a very, very big role in all this corpus accumulation, and that is something that we can never ever deny, or we should not forget. Now, if I had made only about very small amount of corpus, let's say 5x, 10x or less, then I might be scared and I would have run away. But of course, if I thought about it as an opportunity, as many young people think, then maybe I would have invested. I don't know. So we'll have to somehow handle these situations. So this is what I'm trying to say. Imagine that situation. At least theoretically, try and answer this question. What you will do. Don't talk about the markets and that kind of scenario. That's not what I'm talking about. So for my son's portfolio, I had already mentioned this. I have already made sure that money is there in PPF and safe investments for PPF arbitrage and gilts, little bit of gilts for his college education. So I will be able to manage that, so that 58 if the stock market falls by 50%, the corpus will drop, the whole corpus will drop by about 20-30%, 28 to 30% roughly. But that I can still manage that. Maybe I will do some kind of juggling when that 50% happens. So my point is that we must think about the worst that can happen as much as possible, and try and see if we can handle it. Not emotionally, at least logically, if our plan can handle it. That's my question. If we have a plan that can handle it. So it is possible to handle this, provided we are asking the right kind of questions in our goal-based portfolio management, not looking at our XIRR or not looking at daily gains and so on. What is my portfolio worth? If I liquidate it today, how long can I live off that? If it is for retirement, what product or service? If it is for retirement, I must ask how long can I live of that corpus. If it is for some kind of marriage or a college education or whatever, what is it actually worth? What kind of product or service can I afford with that? Am I making the correct kind of assumptions? Are the assumptions reasonable? Inflation, return assumptions reasonable? Should I change them? Every year this should be checked, and every year I must ask, what is the corpus I should have by now as per my plan, and what is the actual corpus I'm having now, and what is the gap? If the gap is too much, that is, if my actual corpus is too less, then how should I change my plan? How should I change my asset allocation to lower risk? These are the kind of strategies that we should think about. That is why I have built in this kind of staggered asset allocation decrease, that is a decrease in equity asset allocation inside the robo advisory template for this kind of de-risking exercise. So please ask yourself that, will you be able to handle such a drop? Will your cash flows be intact? Because if you're going to lose your job, if such a situation happens, and that's very possible, then you may not think of it as an opportunity. You may even exit from the existing equity holdings. So we must try our best to make sure we have enough cash to handle some kind of adverse situation. Maybe not as much, but at least for the next 3 to 6 months of non-employment, we must have some cash flow. Maybe even 1 year down the line as we keep investing, and always commit money to equity that you don't need for the next at least 10 years. Make sure it's 10 years so that you can somehow manage, somehow wait for a downturn, even if it is not as much as drastic as 50%. Of course, all these are I completely agree with you if you're saying all these are hypothetical, theoretical situations. Yes, but such a thinking is necessary to invest in equity, at least when the going is good. When the going is bad, God only knows what we will do.